Welcome back to my channel. In this video, I wanted to cover Google Alphabet. And this company announced their earnings after the market closed, and it looks like the market likes what they had to say. I looked at their earnings, read it from start to finish, and they had a lot of good stuff in the earnings. They grew their revenue really well. Nicely done. Their cloud business is growing really well. Nicely done. And their free cash flow, cash from operations, expanded more than I expected. Again, nicely done. They did spend more money on CapEx, but their cash from operations was much higher, so it compensated for that extra spend. And in all of the earnings and all of their financial data, they don't account for Waymo, which is the robo-taxi business. So it seems like an investor would get the Waymo business for free because it's not included. That's just the way I see it. So let's take a close look at Google Alphabet, look at their fundamentals, see what they had to announce in their earnings, and I'll update my valuation of the company. This is a desirable business, a very strong company that has competitive advantages across the board. In search, nobody does it better than Google. They really earn that dominant position. And they have their YouTube business is the number one streamer in the world. It's even bigger than Netflix. And that's because it's easy for them just to keep rolling out content because everybody's doing it for them. Yours truly, I created this video. It's going on YouTube. Even the big studios and cable networks have to go on YouTube to be relevant. So it's quite a great business because they don't have to put out any money into production, just about. So the Google business is just really strong on all fronts. And I do consider them to be one of the top companies really in the world. So let's take a look at their fundamentals and see if they're priced right, because it could be a great business, but I still want a discount. So let's take a look. Market cap for Google, $1.9 trillion. Revenue, $350 billion. Huge company. Man, humongous. That puts it at about 6 times sales for the company. And they're growing roughly at around 10% per year, top line sales. PE ratio is up to 20. They had a nice rally today. Looks like they're going to rally tomorrow if the after hours rally sticks. Analysts like the stock and they think it's discounted by 24.7. Now, one of the stories that's been ailing the stock is that the new AI applications like OpenAI and others are going to take away market share from search. And I would concede that, yeah, that's a possibility. But Google also has Gemini, which is a pretty impressive application in itself. And I think that's going to be interesting to see if the Gemini business is also going to add value to the company and how they fend off I think the transformation of search. I think search will be different in the future. And I'm willing to bet that Google is smart enough to change with the times and make Google search adapt to the way that the market needs it to and the way in the direction where technology is going. Over the last year, this stock is pretty much breaking even. If you bought the stock a year ago, held it, you'd be up 1%. Over the last 5 years, you'd be up 153%. So over the 5-year, looks good. Over the 1 year, not so good. And principally, it's that story that OpenAI and there's also the courts are trying to decide. They did decide, the courts, the FTC, the Federal Trade Commission, they won the case against Google saying that they are a monopoly. And I would have to kind of agree. They've been so good, they became dominant. And now they're trying to see how they can make Google change or do things that would then allow the market to use their technologies in a way that's going to be good for the market, for consumers, for everyone that's involved. I got my fingers crossed that they do not take away any of the key technologies from Google, like Chrome. It's being debated whether Chrome is going to be separated from Google. And I'm hoping that they leave the company intact. This is another great American company, and I think they're going to be better if they keep all the parts. And I think they could keep serving the billions of customers and consumers around the world if they can be allowed to continue to operate. Maybe with some safeguards and following particular rules that the government sets out. But the sell-off is, I think, predominantly for those two reasons. Is search going to see some of its market share go away? And are the courts going to tear away pieces of Google that would make the company weaker? That is the risk. That's the story that's driving the price down. Their financials look excellent. If you're a new investor and you want to look at a set of financials that is kind of like a gold standard, Google is a good company to get your head around and see the certain attributes to a high quality company. Let me point those out. Top line revenue growth. That shows that a company is getting more customers and the current customers are buying more or using more or consuming more. And you look across the board, it's all green on the screen. Just great growth. Even at this gigantic number, $350 billion, they're growing at 14%. That's incredible. Nicely done. So back to maybe the newer investor, you want to look for top line growth. It shows the health of the business. Is it a good product? Is it a good service? Is this company putting a service or product into the market that is in demand? All those things are in place for Google. So they sell a lot. Are they profitable? Well, let's look at gross margins. This is a company that is diversified. They have search, which is incredibly profitable. They have YouTube, which is very profitable. And then they have the cloud business, which is less profitable. There's more cost in that business. When you blend them all, they have a 58% gross margin rate, which is good for a company their size. If you compare them to Amazon, this is better than Amazon. And I'm not sure how it compares to Microsoft. I think it's close to where Microsoft is at. Profit margin of 28%, excellent. If you put money in the bank and they paid you 28%, I bet you'd leave that money in the bank if they were going to pay you that kind of interest. Free cash flow margin, 21%. Again, you go to the bank, they pay you 21%. I'll take so much money to that bank if they're going to pay me 21%. All kidding aside, those measures are excellent. So this is just an excellent company. And it should be. It's priced at $1.9 trillion. It should be very, very good. Now, just to put a final thought for the newer investor, you study these financials to see what a great company looks like. Then you go to a small cap or a maybe lesser known company or maybe a company that's on the rebound and try to find companies that are going to look like this in a year. And then you'll make a lot of money because you'll probably be ahead of the market. Stocks tend to be priced correctly on quantifiable information, earnings per share, and so forth. But they tend not to be efficiently priced on qualitative aspects. So if you can find companies that are going to look like this in a year or two, you could probably make a lot of money by buying into those companies ahead of the rest of the market. Now let's take a look at what analysts are saying. 40 of them cover this stock, and their reviews are the most pessimistic reviews at $159 a share, and the most optimistic is at $230. And on average, I'm going to say they have about a 25% discount. They're basing it on earnings per share. Revenue is expected to continue to grow double digit. So they're going to be $500 billion market sales per year in the year 2028. That's a big business, and it continues to grow. It continues to grow their earnings per share as well. So I've already taken all this data and put it into my valuation, and I'll show that to you in a few minutes. How desirable is Google? And the way I measure desirability is how strong is the moat, the competitive advantages that a company has, and how profitable and how well are they growing, and how much free cash flow are they producing. And Google is part of a select group of stocks, just a few of them, that are as high as I can put them in this quadrant. It's just a great business. They're growing. Free cash flows are through the roof. They're profitable. The only thing that I could say is not perfect is the price. I wish it was discounted more, but it's not. It provides a reasonable discount that I'll get to in a bit. But overall, this is a very desirable business. I can't think of another business that's more desirable. And Google is very strong with their moats, competitive advantages, profit, growth, and free cash flow. So I've valued Google Alphabet based on their intrinsic value of free cash flows as well as earnings per share. Let me take you through that. So their free cash flows look good, very good. And I'm going to take those cash flows and grow them by 10% in the next 4 years. Their cash from operations actually grew by about 20%, but they did increase CapEx. So it left them with about a 12% growth rate on free cash flows. So I think they can grow at 10%. And long-term growth is 4%. I was going back and forth if I should increase that number. It's very realistic that they could actually grow faster than that. It's just such a strong business, but I'll leave it at 4 to be conservative. I'll discount all those values of free cash flow that are set for the future to a net present value. And today, the net present value of all those cash flows is 2.1 trillion. I add a big cash pile they have of $95 billion and take away their debt. I get to $2.2 trillion of equity value. That's what Google Alphabet's worth based on their cash flows that they're going to produce and the cash they have on the balance sheet. The market cap is lower by 11%. So the stock for Google is being discounted by 11%. Earnings per share, I use their most recent earnings per share forecast of $9.08. I'm going to give them a P at 25 and a growth rate of 10%. So I get to a 35% discount using earnings per share. I depend on free cash flows more than earnings per share. So I weigh this 2/3 and then I put 1/3 blend of this value and I get to a 21% discount. 21% discount doesn't seem like a big number, but this is Google Alphabet. And I would actually buy Google or Amazon or Meta. I'd probably, if I didn't own it, I'd buy it at fair value. I own quite a bit of Google Alphabet. So 21% is a good discount. Google stock is a buy for me. Right now, the stock is trading below its intrinsic value. And with a really high quality stock like this, it's rare to have it discounted. And when it is, I think it's an opportunity to buy. It'll never be excessively discounted because it's Google. A lot of investors would pay attention and load up on Google. As I'm sure over the last month, especially, some people have been loading up because the stock had been sold off so much. But their earnings really showed that Google continues to execute, that their products are just the best in the market when it comes to search. YouTube continues to grow. Their Google Cloud business continues to grow. Just a really good business. So I'm a buyer of Google, and this is the second biggest position in my portfolio. And I wouldn't mind if it was number 1 in my portfolio. It's that good of a company. And I think Google in 10 years is going to be worth at least 3 times this stock price, if not more. So that's my video on Google. If you like content like this, become a paid subscriber. If you become a member, you'll get a variety of perks, which include the tools that I use to analyze companies. You get access to my valuations. You get access to member-only videos and member-only calls as well. So consider it. It'd be great to have you as a member. So that's my video and review of Google. Thanks for watching. Good luck with your investments.